Well, convertibles typically do very well in a volatile equity market and also a rising interest rate environment. In fact, if you look, it's interesting, if you look at how convertibles have performed relative to the S&P 500 by measure of the VXAO, which is the Merrill Lynch Convertible Index, they've actually outperformed the S&P 500 over the last 20 years with less volatility. So I think as we come into an environment where you are really going to see rising interest rates, as you point out, and ensuing volatility, convertibles should do very, very well. We've seen that in the first part of this year, where actually convertibles have outperformed the general equity market, which is consistent. The nice thing about convertibles is you're getting the income, which supports the value, if you will, of the bond, but you're also getting the upside potential of the underlying equity of the convertible. So think of a convertible as really a bond with an equity call option. And that's the way the market views it, and like I said, they do perform very, very well during volatility and rising interest rates. We look at it as really sort of a way to invest in the equity markets on a risk-managed way. Again, you're getting the income to support the underlying equity, but you're getting that equity participation with respect to improvements in the general equity market and the underlying stock. So when you're looking at times of volatility, it's probably wise to think in terms of perhaps increasing your allocation to convertibles, given that they do well in those ensuing environments. The nice thing about investing in a closed-end fund that invests in convertibles is, again, we're able to utilize leverage, so we can borrow at relatively low rates on a short-term basis, and we can reinvest that at a higher rate. So the shareholder will benefit in that they'll earn that spread between what they're paying in borrowing costs and what we're able to reinvest the proceeds at. So it typically does very, very well in this environment. And again, the closed-end fund is nicely featured in that we manage it. It's an actively managed product, and we're able to utilize that active management through income and through total return to produce not only equity appreciation in the underlying in the stock, but also to give out a nice distribution for our shareholders on a monthly basis. Well, there's a lot of value right now, I believe, in the global market. Global markets have done well. They did well last year. Emerging markets did relatively well, and Europe did well in 2016. Those markets have not done as well this year, so I think you could make the argument that there might be some valuations there, better valuations, relative to what the U.S. markets are. So I think it's always wise to have diversification across a global platform, and how you move that up and down depends on what your general thinking is of where you want to be in the globe. But I think it's always good to have diversity. It's just a matter of how you move that depending upon where you see the opportunity. And our funds allow you to participate both in the domestic fixed income market, the domestic equity market, but also the global equity and the global fixed income market. And again, it's actively managed, so we can move in and out of different sectors as we see the opportunity within those various components.